Are you waiting for the real estate market prices to bottom out? Well, I hate to be the bearer of bad news, but it already happened. Happened the last quarter of last year, 2022. It was exactly a year ago, last May, when the interest rate or the mortgage rate shot to above 5%, almost doubling. And we saw an immediate response by the buyers of pulling back in activity. And then consequently, we saw inventory rise as properties weren't selling. And that was again last year. So peak, the mortgage rate had risen to above 7% at the last quarter of last year. And that was essentially when prices had dropped to its lowest point. We had situations where the sellers were afraid because of the rising interest rate that they couldn't buy their next home without having to give up their already low, many people having 2 to 3% interest rate. So they held on rather than putting their properties on market. And that obviously had negative impact. And we're seeing the result of that. To illustrate, let's look at some data. So we're looking at MLS data here in Santa Clara County. So we're looking at a county level. So let's look at some data. So this chart shows average days on market and also sales to list price ratio. Sales to list price ratio meaning what percentage of properties were selling above list price. So if the number is 112%, the average homes were selling for 12% above list price. We see that starting June, the prices essentially go off the cliff. And it's been continually going down until November, December, when the mortgage rates had hit above 7%. And starting in January, as a result of low inventory because sellers were not putting properties on the market in fear of high mortgage rates, now we're seeing, due to the low inventory, prices starting to go up because the buyers that are in the market right now tend to be more serious, more financially sound, are less affected by dips in the mortgage rates. So essentially, we're seeing wealthier and better positioned buyers competing for the few properties. So we're starting to see, starting this year, dramatic competition and corresponding rise in prices, as you can see here. The second chart we're looking at here is the number of homes for sale versus homes that actually sold. And again, if you're looking at May, we're starting to see that divide between what's available for sale and what actually sold. Starting in June, that divide or delta is starting to spread. And it keeps spreading, and the number of homes selling starts decreasing until it hits the bottom in January of this year, and then starting from February, it's starting to rise. So at least for a full quarter, it's been on the upswing. And if we see on a macro level, today the Fed raised another quarter point. And indicated that this may be the last and maybe at a pause, which also leads us to believe that probably towards the latter part of the year, we're going to start seeing a decrease in interest rates if the indicators for inflation keeps trending downward. So the likelihood of rates going up is not high, and that will probably result in more sellers coming onto market to put their properties on for sale, because all the indicators are that the worst of times in real estate looking like it's behind us, especially with the continued banking instability that we're still seeing. The likelihood of the Fed continually raising interest rates, that possibility probably seems less and less as we progress forward. So what does all this mean? Mortgage rates, as we have learned, is the most important factor in real estate transaction. So now that we're seeing what looks like an end to the continual rising of rates, that fear is no longer going to be with us. Sellers are going to be more confident. They're going to be putting their properties on market because we're seeing a lot of competition and they want to benefit from that, right? Sellers want to get as much money as possible. And with all this competition, they are seeing that. I submitted an offer yesterday at a house in San Jose that got 40 offers. So it's going to be way above 25% or more above what the property was listed for. And this is not an unusual case. There was another property in Cupertino that sold for almost $1 million over list price. So yes, these are extreme situations, but we're starting to see them happen more and more like we used to a year and a half ago. It's all about confidence, right? It's all about consumer confidence. And with mortgage rates coming down, competition coming back into play, we're going to see more sellers willing to come out and play and come back into the market to benefit themselves from all this competition. So we're going to be seeing a lot more vibrant and certainly a lot more active marketplace as all of this activity starts to increase. And as I always say, follow the money. As the sellers see that there's money to be made, they're going to be coming back on market, putting their properties on MLS for sale. That will bring in buyers as the interest rates will be coming down and they can see that refinancing to lower rates is a viable option that they can see down the line. So everything will follow its course. Simply follow the money. So if you're one of those people who still think that the market is, the real estate market is looking to bottom out, hate to tell you this, the data doesn't support your wishful thinking. Take it for what it's worth. The data is indicating that the real estate pricing has bottomed out for us, at least here in Silicon Valley, final quarter of last year. So that's where we stand. For more real estate news and tips, please follow me.